Good afternoon, folks. Happy Monday and welcome to Weekly Commentary. This might be a bit long as it's been a week or two since I've updated you, and that is because with the summer months upon us, my wife and I, we do like to do a bit of traveling, and as a result, the commentaries won't always be weekly and won't always be on Friday. They will, however, always be timely. As well, while traveling, I am never, unfortunately, truly away, as I am in daily contact with my staff back in the office. The winning streak we've enjoyed for so long on Wall Street ended early last week, at least for now. The selling began Wednesday, it accelerated Thursday, and then going into the weekend, Friday, we saw a blow-off that sunk the NASDAQ by 4.2%. The driving forces behind the sell-off were the earnings call following Broadcom's earnings report Wednesday, that was after hours, and then a strong labor report Friday morning before the market opened. While Broadcom reported better than expected revenue and earnings on the conference call, they failed to raise expectations beyond what was already anticipated. That bit of conservatism led to a near panic in the chip sector, a bit of an irrational response, I believe. Then Friday morning, the jobs report showed much better job creation than expected, with over 188,000 new jobs versus the 80,000 expected. That brings a 3-month total to over 500,000 new jobs spread across numerous sectors. Now, on the surface, that looks like good news. However, with a market that continues to fret over the fear of higher interest rates, this strong jobs report did raise concerns about a possible rate hike later this year rather than rate cuts. Now, as we saw throughout 2022, risk assets across the board sold off massively on fears of higher rates, this time perhaps a 25 basis point rate hike. And for those of you who remember my commentary from 2022, when we saw the same fears cause markets to decline, it was irrational. In hindsight, it turned out to be irrational. I believe these fears are short-term and again misguided, not because there isn't now a higher chance of a possible rate hike, rather because of what that rate hike may portend. The conventional thinking and fear that a 5% 30-year bond rate is a compelling alternative to stocks seems to miss the mark, at least as it concerns the riskier side of markets. Investors who seek the outsized returns more volatile assets typically deliver aren't likely to shift gears into fixed income because they might earn a quarter point more in interest. May be applicable to dividend-seeking investors, but those investing in things like crypto, gold, which is a volatile area, technology, etc., it's not likely. It's more likely that those investors would shift gears if higher interest rates looked likely to bring on a recession. But when higher rates may be in the offing due to very strong employment market, accelerating GDP and earnings growth, that too, those fears, also appear misguided. More likely, the selling last week, especially the blow-off Friday, was a knee-jerk reaction that kind of took on a life of its own as it progressed. Now, as I type today, Monday afternoon, we are seeing a bit of a reversal, but this isn't to suggest that we don't have short-term headwinds to be concerned about. We do. Tariffs and the conflict in Iraq continue to present mild inflationary pressures that could worsen, which could then lead to even higher interest rates that may, longer term, cool the economy a bit. There's also short-term concerns about the upcoming 3 massive IPOs coming to market, beginning with SpaceX later this week. The fear is that these IPOs will suck the oxygen away from other tech sector companies as money flows in their direction at the current company's expenses. However, despite the anticipated $1.7 trillion valuation of SpaceX after the IPO, only 75 billion of that will be represented by the initial publicly traded float. Now that's a big number, but it's not likely big enough to cause damage to other publicly traded tech companies. The same can be said about the Anthropic and OpenAI upcoming IPOs later this summer. And in general, I'm more of a macro analyst and asset manager than a micro analyst, meaning that I focus on larger, longer-term trends rather than short-term issues, noise, that does create volatility. Now, despite short-term risks and concerns, including valuations and a significant run-up run higher, I should say, in tech, particularly chip stocks, risk and concerns that will create ongoing volatility longer term, it is my view that the bull picture remains intact. AI is not a bubble, it's an evolution. 30 years ago, the internet was an evolution as well, but it was also a bubble. Again, differences abound. Like 30 years ago, this evolution will have its winners and losers. However, the winners appear easier to identify now than they were then. Back then, while many companies lost most, if not all, their value, those that didn't saw returns of between 10x and more than 100x over the following 25 years. I don't see it taking 25 years for this evolution to reveal its strongest winners. It's not to say that we're going to see 10x to 100x winners in the short term. However, with many companies currently benefiting from this evolution, already very profitable, printing revenue hand over fist, with reasonable expectations for more to come, the bigger risk is volatility as opposed to significant loss. Stocks will get ahead of themselves sometimes with dizzying spurts of gains. When that happens, it's often followed by sudden gut-wrenching sell-offs, such as the one we saw last week, particularly Friday. Folks, that's volatility, not losses. Participating in this evolution, however, for investors near or in retirement requires great care to ensure that volatility doesn't impact retirement cash flow in the short and medium term. Those of you who have been with us, especially for a long time, know that is exactly what we do. One area of concern I do study ongoing is the longer-term trend of overall returns in the S&P 500. With reinvested dividends, the S&P 500 has returned roughly 11% per year over the long haul. This average, however, has been achieved through 10 to 15-year periods of returns, often significantly higher and lower than that. It's my view, with the increased efficiencies of this new evolution, that 11% average may climb somewhat going forward. However, sticking with the current longer-term average, it's worth reviewing where we are currently as it relates to longer-term trends for the overall market. When viewing the past 10 and 15-year average returns, investors might be justified in being concerned about what the next 10 or 15 years will look like. Because for the 10 and 15-year periods ending in 2025, the S&P 500 returned an average of 13.3% and 14.5% respectively. However, these outsized returns came on the heels of a 66% decline during the financial crisis. Looking respectively at the 20, 25, 30, 35, and 40-year returns, they normalized to roughly 11%. Over all those time periods. In other words, the outsized recent 10 and 15-year returns simply brought those longer-term returns back into normal ranges after the declines associated with the dot-com bubble and the financial crisis. More important question from here, obviously, is longer-term perspective. From a longer-term perspective, where do we go from here? All right, if we move 10 years into the future and then want to review the previous 20 years, that is 2016 to 2035, to get to an 11% average over that time, we would expect a 9.2% average over the next 10 years. If we do the same exercise for longer term periods in the future, we see expectations at roughly 11% per year in line with long-term averages. I hope this isn't too confusing. The point is that despite above average recent 10 and 15-year returns, that hasn't put the longer term trends or future expectations out of whack. Now that too is very different from 30 years ago. If we look at the period ending 1999, the prior 10, 15, 20, even 25-year returns were over 17% per year. These returns push the longer-term trends so far outside historical norms that it took a decade, the first decade this century, of roughly 0% returns to normalize the longer-term trends. Now, while your heads may be spinning with this data, the upshot is that this is one more major difference between that prior tech evolution and the current one. I'm going to continue monitoring the short-term issues, the noise as I put it, to put into perspective and try to determine whether that noise evolves into concerning longer-term trends. If it doesn't, I'm not going to be overly concerned with days like Friday or even longer term, more, I say longer term, maybe a couple of months of more painful downside, which may happen sometime over the next couple of months. Not predicting it will, but it might. But I'm not going to be concerned about it unless what precipitates that is truly causing a concerning longer term trend. As always, I'll keep you posted as often as I can with all the ups and downs in the markets and changes in current events. Until then, have a great week.